Good day, everyone. My name is Hefzibah Salifu, and you are welcome to today's webinar on the economic landscape of Nigeria with a focus on the first quarter of 2023. You're very welcome, and sorry for the delay. Now, this webinar promises to be knowledge-packed as we discuss Nigeria's economy, the challenges experienced, while delving into the emerging government and what it promises to you as an investor. It is my pleasure to introduce our esteemed host for today's webinar, Mr. Johnson Chukwu. Mr. Johnson Chukwu is a financial expert with an extensive career spanning over 3 decades. He is the founder and CEO of Cowry Asset Management Limited and has played a key role in shaping the Nigerian financial landscape. An experienced and professional in accounting, banking operations, and investment banking, Mr. Johnson Chukwu has a wealth of knowledge and expertise that has imparted to numerous banking professionals in the course of his career. He is a respected commentator of the Nigerian capital market, and his insights are regularly sought after by policymakers and also other industry professionals. Today, we are honored to have him share his thoughts on the economic landscape of Nigeria in the first quarter of 2023. You are very welcome, sir. And while we wait as he's setting up his screen, if you have any question you would like answered during the course of this session, there's a Q&A box at the bottom of your screen. Kindly drop your questions as they come up during the presentation and will be answered in due time. Thank you. The floor is yours, sir.
So why is it now, if I activate my picture, Okay, once again, apologies for that break in transmission, like they say in Nigeria. So I'm going to start this presentation by sharing with us the executive summary, which is basically to tell us the substance of our presentation and what we'll be focusing on, and to give us a kind of helicopter view of what the presentation is about. So we start by looking at the global economy, as we have done in the previous past presentations. We always start our presentation by giving you a broader view of the global economy. And from that, we drill down to local economy and then drill down to the sectorial performances and the outlook of the different sectors of the economy. As you may know, the global inflation, inflationary pressure is expected to decelerate in the current year, easing pressures on emerging economies. We know that global central banks have been increasing interest rates consistently for the past for the past 1 year. We expect that this will moderate in the current year as we move towards the middle of the year, principally because the base effect will kick in, and then we saw a decline in energy prices in most advanced economies. Unfortunately, that has advanced in the past few days, the past 2 or 3 days. GDPs are expected to slow down in emerging economies other than China. China may not suffer a GDP slowdown because China just reopened the economy as a result of COVID after more than a year of lockdown to fight COVID. It's zero tolerance for COVID. So the Chinese economy is getting fillip from that reopening of its economy. The US similarly has also come up with a resolution. The Senate has come up with a resolution to end all national emergencies related to COVID-19. In fact, I was at Metropolitan Club yesterday, and among the announcements that was made before we started our launch was that the Metropolitan Club will now cease to focus on anything related to COVID, that COVID has now become history. So the Chinese economy is getting the benefit of lifting of all restrictions that we are all COVID-induced. And the US Senate has similarly passed a resolution to end all national emergencies related to COVID. The US Federal Reserve has continued to increase rates, interest rates in the wake of banking crisis, and then in an effort to fight inflation. But interestingly, the US is also, the economy has faced in recent past banking crisis with the collapse of 3 regional banks, which are all expected to have a dampening effect of credit expansion. The basic thing I had to mention this is this. When the central bank is increasing interest rate, what they want to do is moderate consumer demand or by moderating consumer lending. So, but the effect of banking industry failure is similar to what is achieved if the central bank is increasing rate, because when you have banking failure, banks will slow down on their lending. So the central bank, the US Reserve Bank, has to balance between continuous increase in interest rates and as well as the negative impact on credit that will be occasioned by the banking industry crisis they witnessed. The banking industry crisis is not just ending US, it's also spread to Europe, where Credit Suisse suffered a major systemic failure that led to its acquisition by UBS as induced by the Swiss Central Bank. You may as well know that Credit Suisse is one of the 30 global banks considered as systematically important, that whose failure could lead to a multiplier effect on the entire global financial architecture. And that's why the Swiss Central Bank moved immediately to arrest a systemic failure or that could be occasioned by Credit Suisse. Credit Suisse has more than $16 trillion in assets under management. That's multiple times the GDP of African economies added together, just to put it in proper context. Then as we drill down further, we're going to talk on the impact of crude prices. Until last week, or this week, actually, I think last week, crude prices have been moderating, leading to lower inflationary pressure. But interestingly, all of a sudden, without any prior announcement, OPEC Plus members announced that they're going to drop or cut down on crude production so as to shore up crude prices. Of course, we've seen the past few days, crude prices have gone back. Brent, for instance, has gone back to above $80. This voluntary cutting of crude production was Russia offered to cut by 500,000 barrels a day, while Saudi also cut by 500,000 barrels a day. Bringing it down to home, we will start when we get to the Nigerian economic landscape by discussing the political environment. Of course, we are living witness that the Nigerian presidential election was held on February 25th, 2023, and Mr. Bola Ahmed Tinubu, or Asiwaju Bola Tinubu, has been declared as the winner of that presidential election. But unfortunately, the election was marred by violence, rigging, and voter suppression, which led to the two leading opposition members, PDP and LP, rejecting the result of the election. With Mr. Tinubu's victory, then it means that the APC, the current ruling party, will extend its years of governance beyond 8 years, which we are characterized by what we termed as economic failures. But of course, the next government will face a lot of challenges. One, repairing the damage that was done on the economy in the past 8 years, dealing with the issues of insurgency almost across the 4 geopolitical zones of the country, the 3 northern regions and the southeast. In fact, call it the 5 geopolitical zones because you also have some level of insecurity in the south-south. Then you have to deal with the issue of kidnapping, the issue of oil theft, and which has affected or constrained oil production and government revenues. Inflation has continued to remain obstinate in the economy, in the Nigerian economy in the past 1 year or so, 1.5 years, with inflation coming at the rate of 1.91% in February, despite all efforts and continuous tightening by the Monetary Policy Committee. Monetary Policy Committee has increased lending rates or monetary policy rate by 650 basis points or 6.5% since it started increasing rates. In spite of that, we are still dealing with higher inflationary pressure. Of course, the inflationary pressure has a negative impact on consumer spending, which was worsened by the cash withdrawal limits and currency swap. In the first quarter of this year, citizens went through some difficulties. One, dealing with erosion in the purchasing power of their currency, and then dealing with inability to access even their savings or their balances to make purchases as a result of the central bank induced or directed cash swap, currency swap, or currency redesign and withdrawal limits. These are expected to affect the first quarter GDP performance when the figures come out. There has been heightened discussion on the removal of petroleum subsidy before the end of the current administration. We're going to speak more on this as the Minister of Petroleum has announced, Minister of Finance and Economic Planning, has announced that the government will likely take out the subsidy before the end of its term on May 29th. So I think I've been introduced. There's no point to go over that. So we look at the global economic trend. IMF had in January predicted or projected that the global growth of the GDP growth in 2023 will fall to 2.9% and go back up to 3.1% in 2024. This, but the World Bank on its side, had actually forecasted a 3% for 2023 and indicating a slower growth in the GDP. The figures here, the slide you have there, or the bar, shows that the projections for 2023 and 2024 as well as 2025. Sorry, the projections for actual for 2023, the projection for 2020, actual for 2022, projection for 2023, and forecast for 2024. Like as I mentioned earlier, growth in China is expected to pick up in 2023 as a result of the easing of the opening of the lockdown or the suspension of the lockdown. 2024 growth is also expected to gradually recover. It's expected that either the war in Ukraine would have ended by 2024 or that the world would have gotten used to the war in Ukraine in case the war has not ended, and therefore the global economy will begin to recover in 2024. Well, it's also expected that inflation rate will moderate by 2024, like what we call the base effect. One, we're seeing a decline in food prices in major economies of the world. We saw until recently decline in energy prices, and then it's expected that the global economy would have normalized by 2024. There were great concerns at the beginning of this year or towards the end of last year that the global economy would go into a recession in 2023. But that concern seemed to have been overcome by global economists. I had mentioned that it's expected that the global economy will grow even in this year by about 3% or 2.9%, depending on whose figures you're looking at. But at the beginning of the year, there were great concerns that the global economy was going to go into recession. At that point, the concerns that were Europe, that Europe could go into recession and the US could go into recession. But both economies have been able to sidestep those concerns and have continued to grow in the current year. I had mentioned earlier that oil prices had been declining until recently. So it was projected that oil prices would actually fall by 16% in the current year, which what we saw a constant decline in the price of crude, or even to the end of March. But OPEC, led by Saudi Arabia, and the OPEC Plus, led by Russia, have implemented a deep cut in crude volume by 1.6 million barrels a day. And that has led to a reversal of the projections that oil price could actually decline by about 16% this year. Of course, the downside risk of the economy remains. Those downside risk is that Chinese recovery could stall, the war in Ukraine could escalate with sometimes threats. Now Ukraine is threatening an offensive. And with the armored tanks that be provided by Germany and other Western countries. So it's expected, they are concerned that could lead to escalation of that war. And they are dead distressed by major emerging economies, Ghana being one of them. Ghana had declared a default on its both local and foreign currency debts. And they are concerned that could also spill over in some other countries. Persistent high inflation, sudden financial market crisis. We have talked about, we know that 3 US banks have failed. You have the Signature Bank, and then you have the Silicon Valley Bank, and these banks and Springtime Bank have all collapsed. And I had mentioned earlier that Credit Suisse Bank has also gone into crisis to the extent that it has to be acquired by UBS, one of its major competitors. In some countries, inflation has spurred, particularly for emerging economies. The inflationary pressures have we are driven by one, food inflation, and two, for emerging economies, depreciation of the local currency. Nigeria is one of those countries that suffered higher rate of inflation, partly because of increase in food prices and as well as depreciation of the local currency. So it's expected that in 2023, 84% of countries are expected to have higher headline inflation. I had mentioned that some factors are beginning to impact on all item inflation. We're talking of declining food prices in other countries, not in Nigeria. Declining energy prices. Of course, Western economies have not suffered as much depreciation in local currencies as third world economies. So you find out that while inflation is moderating in more Western economies, it's actually still obstinate in emerging economies. Global trade had actually declined, or is expected to further decline in 2023 to about 2.4%. If you look at the figures there, you will see, based on the World Trade Organization's figures, global trade in merchandise was about 3.5% in 2022, but it's expected that this will all moderate in the current year. Let's now go to the economic powers of the world, the major economies of the world, their performances in the past year and their projections for the current year. Okay, if you look at the US, I had mentioned that advanced economies are expected to have a decline in growth from about 2.7% to about 1.2% in 2023, before rising back to 1.4% in 2024. This will largely be driven by the major economies of US and the Western economies. The concerns earlier that these economies will go into recession have been unfounded. So if you look at the US, for instance, annual inflation has slowed down to about 6.4%, to about 6% from 6.4% in February this year. The most increases they saw was in electricity and shelter, and that's housing. Food prices grew at a slower rate, while cost of used cars all declined in the period under review. Of course, the inflation of 6% is still higher, much higher than the Fed target of 2%, which implies that the Fed has indicated that it will continue to tighten liquidity by increasing rates until they are able to rein in on inflation to go back to their target 2%. But I had mentioned earlier that the concerns are that if the US continue to tighten rates, and the banks at the same time also continue to tighten credit based on the concerns of financial system stability, then you could have a multiplier negative impact on US GDP growth rate. So we've seen the Federal Reserve increase rates between 4.75% and 5.1%. And the 5.1% seems to be the peak that they've seen in recent past. Of course, the implication of this and not far-fetched. I've spoken extensively on this, that you're going to have higher cost of borrowing. For economies like US, where they have a well-developed consumer market, increase in inflation in interest rate will lead to increase in lending rates, which will put a lead on capacity of consumers to borrow. So you find out that at periods when Western economies, where there's a clear linkage between consumer spending and credit, is well established. So increases, I know, for instance, if you go to a place like UK, where rates have gone up, you've seen a collapse in property prices. We've seen situations where people are no longer in a position to borrow for mortgages in the United Kingdom. And that has led to a kind of moderation in property prices. We've also seen, we go to the US. I've spoken extensively on this, that we've seen banking failures in US, particularly 3 regional banks. Silvergate Bank was the first to announce that it will wound up on March 8th. It was followed 2 days after by Silicon Valley Bank. The basic thing I had to emphasize here is that these banks, including Signature Bank, actually suffered multiple challenges, and those challenges were largely driven by the decision of the Federal Reserve Bank to increase rates. Basic thing that happened to, for instance, a bank like Silicon Valley Bank was that during periods of low interest rates, Silicon Valley Bank, which had mobilized a lot of deposits, about $22 billion in deposit, had actually become a major bank for tech companies. And so what they did was they invested heavily in in bonds, federal government bonds, whose price have begun to go up, and because of the increase in yield, their prices have continued to come down because of the increase in yield. And as you know, when yield increases, price of bonds come down. So because of the increase in yield, the depositors of in SVP, as we call it, Silicon Valley Bank, began to withdraw monies from the bank, because these tech companies were largely dependent on private equity funding for their investments. Private equity funding slowed down because the rates were higher. So the private equity firms would rather play in the bond market, current bond market, or in money markets instead of putting their money with telco companies. So the telco companies had to begin to withdraw. And because the value of those bonds held by Silicon Valley Bank had declined, they were no longer in a position to meet obligations by selling those bonds. You know, the generated deposits that use the deposits to buy instruments, fixed income instruments. The value of those fixed income instruments declined, but the value, the liability did not decline. So they needed to raise fresh money. So when they now came and announced on March 12th, that they needed to raise, on March 10th, that they needed to raise about $2.25 billion to shore up their balance sheet. Depositors had an immediate run on the bank, and the regulator had to step in. The California regulatory, the California State had to step in to take over that bank. The same thing happened in Signature Bank. But the summary of it is that the banking failure we saw in the US were largely caused by the steep increase in lending rates by the Federal Reserve Bank. Oil prices suffered their biggest decline on March 15 by dropping by 6%. And these declines that we saw situation where Brent had gotten to as low as $71 per barrel was what triggered the OPEC Plus to take a decision late last week to cut crude production by about 1.6%. So there, a couple of things are going to change. The projection that oil price could drop by 16% this year will now we have to be reviewed. The projections on inflation will also have to be reviewed. Of course, we know the US government was not happy with Saudi Arabia for ambushing them without informing them they're going to cut back on crude production. So we are seeing sharp increases in prices of crude and energy sources. We've seen for countries that are major oil exporting countries like Angola, we've seen an appreciation in their government bonds, which is expected that they should enjoy some windfall effect of the higher crude prices. I talked extensively on the collapse or the failure of Credit Suisse that had been acquired by UBS. The key thing that we must mention at this point is that the global financial system is apprehensive that nothing should happen to UBS. Should UBS fail, the Swiss Central Bank Reserve is far an inconsequential amount as to be able to deal with a UBS failure. Like I said earlier, Credit Suisse is one of the 30 systemic important banks in the world, and UBS is also one of those systematically important banks in the world. So UBS, as it stands today, the world is praying that nothing should happen to UBS. United Kingdom, interestingly, in February, inflation rate reversed again to about 10.4% in UK from 10.1%, contrary to the 4 months decline we had witnessed. Of course, if you look at that graph there, you will see consistent decline from 11.1% to 10.7% to 10.5%, 10.1%, but it increased back to 10.4%. What are those factors that drove increase? Partly food inflation. Food inflation driven by vegetables due to shortages of salad produce, and other vegetables are a result of bad weather in Southern Europe and Africa, where most of the vegetable items come to UK. But there was a slowdown in core inflation. Core inflation saw a slowdown in fuel, in furniture, in housing and utilities, and in recreation and culture. But like I said earlier, that decline in energy costs may likely reverse as a result of the cutback on crude production by OPEC+. So annual inflation in UK came to the core inflation was about 6.2% in February, up from 5.8% in January. I tried to go through this so that we can quickly get to the Nigerian segment of our presentation. The British economy expanded by only 0.6% a year. The worst it has suffered since first quarter of 2021. UK economy was actually projected to decline by about 0.6% this year. But like I said, the projection that these economies will go into recession seem to now be a subject of fresh consideration. So the Bank of England increased key raises key bank rates to by 25 basis points to 4.25% in March. That is during its meeting of last month, all in an effort to rein in on inflation. I had mentioned the implications of this Bank of England trying to moderate inflation rate. I had mentioned that we've seen property prices in England decline as a result of higher inflation rates. And if you look at UK mortgages, they are tied to the monetary policy rate. So whenever the Federal Reserve Bank, whenever the Bank of England increase rates, the banks, UK banks will automatically adjust their lending rate to mortgages. And that is why we're seeing property prices go down in UK. But of course, there are also concerns about the UK financial system. Although the UK financial system regulator said that the banking system in UK remain robust, they have strong capital, and they are resilient. So they don't think what happened to Credit Suisse could actually affect UK banks. Of course, we know that HSBC has acquired Silicon Valley Bank in UK to avoid further any systemic risk associated with that. China, one of the few economies among the emerging economies that were expected to grow faster this year. But interestingly, last year, the GDP only grew by 3%. The lowest it has suffered has grown in over 40 years. And that could explain why the Chinese government decided that it was time to lift all restrictions associated with COVID, so that the economy begin to grow. So with the Chinese reopening, we are beginning to see economic activities in China. China, interestingly, is one of the countries that has continued to enjoy very low inflation rate. Chinese inflation fell to 1% in February this year. And China has said that it's one of the countries that has maintained low inflation rate, irrespective of the fact that the global economy has suffered high inflation rate all over all this period. The Eurozone and Canada. The Eurozone expanded by 3.5% last year. Of course, that was below the 5.3% recorded the preceding year, which was 2021. But growth is expected to bottom out to about 0.7%. I had mentioned earlier that there were concerns that the European Union, UK, and US could go into recession, but they seem to have sidestepped any recession this year. Canada has also had another growth rate of 3.4%, just about the same rate that the European Union grew. Canadian inflation rate has dropped to 5.9%, to 5.2%, down from 5.9% it recorded in January. Of course, that drop in Canadian inflation rate was driven largely by lower energy costs, which I had mentioned earlier, that the lower energy costs could be reversed in the coming months, given the spike we've seen in crude price as a result of the cutback of crude production. Now let's come to Nigeria, which is for us is the center of our conversation today. So we'll start by looking at the political environment. I had mentioned earlier in the executive summary that Asiwaju Ahmed Bola Tinubu has been declared the winner of the February 25th presidential election. The election, we all know, was marred by issues of violence, thuggery, particularly in locations like Lagos, in locations like Rivers, Imo, voter suppression, and that led to the election recorded one of the lowest turnover in terms of voter turnout compared to the previous elections. Of course, this election was the 7th presidential election we are holding in the Fourth Republic. And it was also the first presidential election to be conducted with BVAS, that is by modal voter accreditation system, which had promised that voters will be accredited and the accreditation will be, and the results of the election will be transmitted from the polling units. But that was not the case, as the BVAS ability to transmit results was, particularly the presidential election, seemed to have been betrayed, as the INEC claimed it was challenged by technical glitches. Most local and foreign observers believe the electoral process, particularly the process, fell short of expectation of Nigerians, and the result is still contestable. If you look at foreign media publications and opinions, editorials, some of them felt that the process fell far short of the expectations of Nigerians. So if you look at, like I said earlier, this was one of the elections with the lowest attendance or voter turnout. If it's the figures we saw, I needed to go by. If you look at the presidential election in 2015, Mr. President, current President, Mr. Muhammadu Buhari won by 15 million votes, 15.4 million votes. He also won by 15.19 million votes in 2019, but Mr. Asiwaju Ahmed Bola Tinubu won by 8.7 million votes, which is almost half the number of votes that Mr. Buhari won in previous elections. So, and that highlights those issues I raised. For the first time, Nigerian youth were very passionate about the election. These are people who have been used to being passive about the elections. But unfortunately, some of them did not meet, the election process did not meet the expectation of many of the youths. Now let's go to the economy, Nigerian economy. The GDP, Nigerian GDP in the fourth quarter slowed back to 3.52% compared to 3.98% recorded in the preceding in quarter 4 of 2021. But when you compare the quarter 4 performance to quarter 3 performance, it was an improvement from the 2.2% recorded in quarter 3 of 2022. But on an annual basis, the GDP grew by 3.1% for in 3.1% compared to what you had the preceding quarter. I had mentioned earlier that the central bank, in an effort to fight inflation, has continued to increase interest rates, and we have had 650 basis point increase. Of course, the implication of continuous increase in monetary policy rate that we are having to deal with raised domestic borrowing costs, which is cutting down on inflation, on investment. We all know that apart from business that have short asset conversion cycle, that is difficult for businesses that are into this sector productive activities to borrow at the current lending rates that are ranging between 25 and 30%. So looking at the sectorial performance of the GDP, you can see on this slide that agriculture still accounts for the largest contributor to the GDP, about 25%, followed by ICT. ICT is actually an interesting story because this is a sector that used to account for an inconsequential or insignificant portion of Nigeria GDP, but has over time grown to now begin to rub shoulders within the agricultural sector and has gradually overtaken the trade sector that used to be traditionally the second largest contributor to the GDP. We've seen manufacturing sector at 8%, mining sector at 5%, real estate sector at 5%, financial services at 4%, and then construction at 3.5%. So these are the makeup of the GDP of the country, and also indicates to you which sectors are driving economic activities. has spoken extensively on this, that the inflation rate has moved from 21.82% it was in the month of January to about 21.91% in February. The rise in inflation rates still remain the same factors we have spoken about at previous meetings. High food prices occasioned by insecurity in the food production base of the country, depletion of local currency, which has led to pass-through effects of import, what they call import-induced inflation, high energy costs, due to high prices of diesel and high prices of fuel, occasioned by for the fuel, partly because of the depletion of local currency and partly because of scarcity occasioned by inability of the federal government or the NNPC to supply enough to weight the Nigerian market. So the major factor driving inflation, as I mentioned, is the food inflation. The food inflation came at the rate of about 24.32% in February, up from 23.75%. This is actually what discussing further, because for an average Nigerian household, their basic consumption or expenditure is on food. So when food inflation is about 24%, it simply means that the average household has lost about a quarter of their disposable income, because effectively most average Nigerian household, because of the level of poverty, largely spend on food and food-related items. So another thing that is worthy of discussing is the challenges that the household went through in the first quarter of this year. We know that the central bank came up with the directive that the Nigerian currency was going to be redesigned, and that the central bank did not just about that, they also put a major lead on ability of bank customers to withdraw from their bank account. So we had severe cash scarcity that led to people almost spending the whole days of their life in the past couple of days trying to make withdrawals from their banks. So the impact of this is that we're likely going to see a depression in GDP performance occasioned by the fact that people are unable to withdraw monies to spend on basic needs. So you realize that most households, we are actually focused on only spending on what they call critical, what was critical for them to remain alive. And the most affected will be the informal sector that currently covers about 65% of the GDP, because the informal sector actually largely run on cash. And we're talking about people whose total turnover in a day may not be more than 20,000 naira, 30,000 naira, but they couldn't make sales as a result of the lack of cash occasioned by the CBN directive. So we expect that this will have a dampening effect on the GDP in the first quarter of this year, and could also affect the trust that an average banking customer will have on the banking system, that which could lead to people attempting to keep their cash reserve at home instead of keeping their money in banks if they suspect this could happen again in future. The central bank at this MPC meeting of March increased the cash reserve ratio from 17.5% to 18%. Although it kept the monetary policy, it kept the cash reserve ratio at 32.5% and liquidity ratio at 30%. The implications of this had mentioned that borrowing costs have gone up, and we're going to talk more of this when we get to the banking sector, when we drill on the banking sector. Borrowing costs have gone up, but deposit rates have not gone up because many depositors are not in a position to negotiate, or do not what they call the market power still resides with the banks. So most depositors are stuck with whatever their banks are willing to offer them. And the banks seem not to be very aggressive with deposit population, because the banks keep telling you that, look, that the central bank keep mopping up excess liquidity from them in form of cash reserve. On the positive, Nigeria's crude production has continued to increase in September last year, averaging about 1.3 million barrels a day in February. I think it even plateaued about 1.6 million barrels a day. It has gone to about 1.96 million barrels a day before the end of February. And I think there's a report I saw that it has gone to about 1.7 million barrels a day now. So it then means that the measures taken by the federal government to rein in on oil theft and vandalism seem to be affecting, yielding positive results. And Nigerian Upstream Petroleum Regulatory Commission has also said that they are likely going to bring in additional 900,000 barrels of crude into production in the next couple of weeks. What that would mean that if they are doing that, then Nigeria will begin to enjoy the benefits of an crude oil windfall as a result of the increase in crude prices occasioned by the cutback in crude production by OPEC. But I doubt if we're able to achieve 900,000 barrels a day addition, whether it wouldn't have a dampening effect on the market. Because remember, the cutback is only 1.6 million barrels. So if we come up with 900,000 barrels a day, we would have replaced part of that cutback, which could affect crude prices. But the most important thing is that we are seeing a consistent rig count about 13 rigs currently, and that we have seen a consistent increase in average crude production to about 1.3 million barrels a day in February. Of course, if this continues, it will have also effect on our reserve and possibly lead to a stabilization on our exchange rate. Now, the federal government is now mouthing that they want to take out subsidy on petroleum products. It's expected that that subsidy would drain about 6.3 trillion naira from government resources this year, or about $13 billion. I think the minister has said recently that they are currently spending about 440 billion a day to subsidize petroleum products. So, Minister of Finance for Budget and National Planning, Mrs. Zainab Ahmed, has said that the country can no longer afford to continue to subsidize petrol. But interestingly, we have gone through this route multiple times. And we've seen previous governments try to remove the subsidy, and then there's a pushback. I had actually, in one of my conversations, said that the incoming government, we have to be more circumspect in taking a subsidy as a first item on assumption of office, because there is a lot of, there still seems to be a lot of, they first have to win the public support. The way the election went was so that the incoming government may not have gotten the general public support that will give us the moral authority and strengthen his hands in taking out difficult economic policies like taking out subsidy. I'm clearly an apostle that the subsidy is not sustainable, should be taken out, but I also recognize that it comes with a lot of political challenges. If you look at the history of Nigeria's government attempt to take out the subsidy, in 2000, President Biden attempted to take out the subsidy and there was a pushback by the organized labor. At that point, we only spent about $2 billion to subsidize petroleum products. And now we're spending about $13 billion. In 2012, immediately Dr. Goodluck Jonathan won the presidential election. He tried to take out the subsidy. There was a massive shutdown. There was almost a shutdown of the economy. That increment was supposed to, taking out subsidy would have led to an increase in price from $65 naira per liter to about 141 naira per liter. We all living witnesses to what happened in 2012. In 2016, President Buhari said he did not pay subsidy. Rather, what they had was over recovery. Principally because we know that crude price dropped to almost zero in 2016 as a result of a global economic crisis. So that may not be a good parameter to determine whether the government has capacity to take out the subsidy. The current government has also said repeatedly that it was going to take out the subsidy, but it has not done that. The problem with the subsidy is that it weakens government revenue, it leads to higher borrowing, and because the government has continued to spend on the deficit budget, so whenever it cannot generate enough revenue or is spending this generated revenue to subsidize petroleum products, we will continue to build up our national debt, which has grown to about 46.25 trillion naira at the end of December, about $103 billion. We know our reserve is just about $35 billion. So our debt, national debt in dollar terms is now about 3 times our foreign exchange reserve. We also know that the entire debt is not about foreign, because if you look at it, the domestic debt is about 27 trillion naira, about $61 billion, whereas the foreign debt is about 17 trillion naira, about $41 billion. The foreign debt, in any case, is still above the foreign reserve that we have today. These are indicators that our economy is not in a very strong position. Although the debt to GDP is still about 23.2%, but I always make this note of warning that Nigeria should not rely on debt to GDP making decisions on borrowing, because we know that our debt service to revenue is now about 80%. So further borrowing will certainly tip us above to a situation where we have total revenue is not enough to even service debt. Of course, the $103 billion or $46.25 billion does not include the about 26 trillion naira in ways and means funding that have not been formally added to the national debt. And they also contractors' debt that I'm not sure anybody is keeping track of. Then, interestingly, the Nigerian equities market has continued to enjoy some level of buoyancy, some level of boost, in spite of the concerns about the election. So we've seen equity market gain about 5.1% at the end of year-to-date gain at the end of March last year. The greatest beneficiary of that, or the greatest gainer, was a good power plant or power PLC, despite the fact that its financials, current financials, are not as rosy as people had expected. But that particular ticker has gained about 117% at the end of the first quarter of this year. If you now look at the sectorial performance of the NGX, you have the greatest performer being the consumer goods sector. Always know that in periods of economic difficulties, people pivot away from consumption and only focus on consumption essentials, which I had mentioned that people are spending money on what they need to survive. So consumer goods are largely those goods that people will, the last item, the last consumption that suffers in the period of economic difficulties. But I also look at, if you look at the slide before you now, you look at the chart, the bar chart to your right, you will also observe an interesting thing. The market began to rally in November. The market gained 8.18% in November, gained 7.5% in December, gained 3.18% in January, and gained 4.31% in February, but has declined, in March. Because what happened was, after the election, there were concerns about the economic and political stability of the country because of the processes that led to the outcome of the election. So the market seemed to be reflecting on that. Like I always say that, look, the equities market could be a barometer of the economic expectations of citizens, or the outlook or the mood of citizens. When the mood is positive, citizens or investors are bullish in buying equity instruments. And when the outlook or the expectations or the mood is negative, they are bearish in making investments. So the March performance of the market could be an indication that investors are worried about the economic and political future of the country. So I just like to paper over this. Of course, if you look at the volume of transactions and you now compare the domestic and foreign investors, we've known that foreign investors have largely exited in the market. Couple of things: naira illiquidity, heightened political tension or political uncertainty, weak macroeconomic performance, high inflation rates. These are factors that have worked against foreign portfolio investment into the economy. So we've seen a consistent decline in foreigners, foreign portfolio investment in the economy. they said that it had dropped to just about 13.5 billion naira between January and February this year. So these are the factors that had affected the market. The banking sector has recorded a positive, I think I've shown that on the slide, year-to-date performance of 8.5%. We've seen a surge in interbank settlement or electronic payment systems as a result of the cashless policy and the difficulties of getting payments from the banking system. And then, interestingly, I had mentioned earlier to us that some of the emerging economies are under the downside risk of the global economy is among which is the debt challenges that some emerging economies are having. Ghana had mentioned as a living example, and Ghana is planning to restructure, has restructured its local currency debts and planning to come up to investors with a restructuring of its foreign currency debt. It's expected that it's alleged that Nigerian banks have begun to even factor in that restructuring in their P&L, and that some of the huge losses in terms of provision for credit losses by Nigerian banks may be associated with the Ghanaian debt restructuring. But one of the things that Nigerian banks are beginning to do is that they're beginning to diversify their earnings or their risk away from Naira or from moving to other non-Naira operations. ETI, that is EcoBank Transnational Incorporated, and UBA are leading this charge. With UBA's profit, 63% of UBA profit being accounted by African operations. And I think many Nigerian banks may be considering that level of diversification. So now let's move to the banking industry as a subsector by looking at the sectors and how the outlook of the sectors and what we expect from the sectors. Nigerian banks are beginning to restructure their revenue. I just mentioned that away from high concentration of local currencies. And then we're also seeing a newfound law for holdco companies, that is holding companies. Many of the Nigerian banks are adopting a holdco structure, principally so that they can continue to do multiple lines of business and run them semi-autonomously, while as they still share what you may call central costs, so that they keep their cost profile low while they are driving their multiple business operations with some level of focus. A lot of Nigerian banks are also adopting fintech. Many of them are developing fintech companies or acquiring fintech companies. I know eTransact have been acquired by a Nigerian bank. And the key emphasis for them is that they also recognize that the competition is coming from the fintech businesses, and they are beginning to either acquire fintech business or develop fintech competencies. And then the holding companies are helping them to have those run parallel, having their businesses run semi-autonomously without with the necessary skills and competencies assigned to those subsidiaries. So we've seen the likes of First Bank, IBN Holding, Islamic IBTC Holding, FCMB Group, GT Group, Access Corporation. Recently, Sterling Bank and Zenith Bank have also joined the holding company structure. So what do we expect from the banking sector? We should expect that the banks will continue to optimize their top line, particularly in terms of interest on loans or on interest income, or from their liability-based activities. But coming with that is also pressures on what we may call cost of credit. Of course, we know when interest rates increase, the likelihood of default also increases. So the banks should begin to expect higher level of provisioning for credit losses as a result of the increase in lending rates. But nevertheless, we expect the banks to continue to enjoy improved bottom line because of migration away from brick and mortar banking services to electronic banking services that requires minimal cost of service for the banks. So the banks are enjoying improved fees and commissions, and also enjoying improved net interest income. But the snag would be that the cost of credit will continue to increase. Now, let's look at the industrial sector. The industrial sector, we've seen growth in major players like Julia Berger, which has appreciated by 10%, Dangote Cement about 3.4%, Transcorp with about 23%. But in terms of performance, the major drivers, we've seen dividend declaration by the likes of Dangote Cement, Bua Cement, WAPCO, but the outlook is that a lot will now depend on the ability of the incoming government to invest in infrastructure. Ideally, if not for economic financial challenges which the many of the government are going to face as they take over power in May 29th, ordinarily you should expect that demand for industrial goods will spike as new governors try to impress the electorate by giving what they call dividend of democracy. But this will be constrained by liquidity available to those government. But if, however, the government succeeds in deregulating the downstream oil and gas sector and free up the about 6.7 trillion naira, about 440 billion naira that is spent on subsidy, and that money is now shared to the 3 tiers of government, you may have the government with more resources to make demand for industrial goods. So the industrial goods potential remain quite strong, particularly if the government is able to access more funding, or if crude production increases by additional 6,900,000 barrels to the about 1.7 or 1.6 million barrels we're currently producing, taking us to something like 2.2 or 2.3 or maybe 2.4 million barrels a day. And then the government will have enough resources to share, and then you should see demand for the industrial goods sector. The oil and gas sector, we have talked extensively on what could happen in the oil and gas sector. Of course, we know the oil and gas sector, only one company is listed of the upstream operator, that's Seplat. And we should expect, the Seplat is not just a crude producer, Seplat is the major producer of gas. But Seplat has also gone through, or is going through, some level of corporate governance issues, which could pose a challenge to investors' desire to invest in that stock. We know MRS is delisting from the exchange. So the downstream operators in that sector their fortune will depend on what happens to the deregulation of the sector. If the deregulation takes place and the FX market is also deregulated, then we should see improved performance of those in the upstream segment, in the downstream segment of that industry. So a lot will depend. This industry will be driven by 2 factors: removal of subsidy, or 3 factors: removal of subsidy on FX or deregulation of the foreign exchange market, as well as improvement in crude production. The TECO company, like I mentioned earlier, has gradually grown from an inconsequential contributor to the GDP to about 16% contributor to the GDP, has actually trumped over the trade sector that he was a customary number 2. And if it continues to grow, we could see a sector that could also overtake the agricultural sector. We know that the world is going digital, and we know that currently the 2 major operators, that is MT and Airtel, have acquired 5G licenses. MT has already rolled out its 5G license. There's also a 3rd holder of 5G license in the country. But beyond that, the telco companies are also facilitating commercial transactions, having acquired payment banking licenses and doing that the payment banking facilities. So these are factors that will drive that sector. So they remain a major growth sector in the economy, and investment in that sector will continue to be viable or profitable to investors. The insurance industry or insurance sector has become the poor cousin of the financial services sector. I read that Leadway has become the first insurance industry in the company in the country to have generated premium dividend premium income of 100 billion naira. And when I looked at it, I said, look, a bank like Zenith Bank generates as 4 times of that as profit after tax in a single financial year. So that sector has remained hobbled by a couple of factors. One, in confidence of the insurance public on ability of, or the willingness of insurance companies to pay claims, poor capitalization, poor, relatively not very strong regulation. And these are factors that the next government have to look at. Of course, we saw an increase in the premium payable on some compulsory insurance like motor vehicle insurance. So we hope that this will have a positive, salutary effect on the industry. But we need one additional capitalization of the industry, which has been in the drawing board for quite some time. The regulator has been prevaricating on enforcing a capitalization. Sometimes they talk of risk-based capitalization, sometimes they talk of regulatory capital. So that industry, which elsewhere in the world, actually some of them, in some locations, they're actually bigger than the banking industry. Today, they remain the poor cousins of the financial industry, given that they have become much smaller than even the PayCom industry that came decades after the insurance industry. The consumer goods, have spoken about this extensively. We expect this sector to remain resilient because when everything is down, people will have to eat, people have to feed, people have to eat some basic things, including drinking. Sometimes people will drink to drive away their sorrow. So at periods of poor economic situation. So we expect that even with the election now behind us, that the consumer goods sector will still continue to enjoy some level of upside. Now, let's look at the bond market. The bond market has been bearish over some time. It was actually expected that immediately after the election, we should begin to see bond prices rise. But interestingly, the central bank came up with a discount rate for T-bills, short-dated debt instruments at above 14% at the last auction. This could now put further pressure on bond prices as the investors begin to demand high yield on longer-dated instruments, unless they could see a trajectory that the economy is going to recover quickly, and then you could have an inverted yield curve. But right now, I don't see an inverted yield curve until the economic outlook becomes clearer. Treasury bills I talked about is the central bank came up with a 14.7% yield on 364-day bills or notes. But the unfortunate thing that the central bank has been very inconsistent in its rates in discounting of treasury bills or the private market auctions, because we've seen some level of zigzag movement in yield that you cannot be attributed to demand, you can attribute to liquidity, and you cannot, there's obviously no connection or no nexus between inflation rate and interest rates or the rate paid on T-bills. We hope that with this decision by the central bank to offer the 364-day bill as 14.74%, we may begin to see situation where yield will begin to mirror or move in the same direction with inflation rates. The Eurobond market, what happened after the Ukraine war, the third world economies or the emerging economies, Eurobonds have suffered severe losses as the US also began to increase rates and the Western economies began to increase rates. So there has been a flight to safety to more secure instruments, which had led to yield on most third world economies bonds increase. For instance, Nigeria's yield has increased from 11.91% to 12.34%. Part of it could be as a result of what's happening globally. Part of it could also be as a vote of a vote of lack of confidence by investors on Nigerian instruments, given our current political and economic situation. The forex market, we've seen some level of stability in the FX market. We're actually projecting that after the successful election, if the election had gone as planned, as expected, and the process made the expectation of average citizens, that the declaration of the result of the election would have led to a rallying of the local currency, but we've not seen that. Of course, we've seen some level of stability in the exchange rate. We've seen the parallel market trading between 740 naira, 45 naira to $1. But a lot will now depend on what will happen to our crude oil production. I believe that the incoming government to sustain the relative calmness we have in Niger Delta that has led to an uptick in crude production. Ability of OPEC to sustain crude prices to sustain their current rallies. This will all affect our our FX market. So for us, a couple of things the next administration should expect to do. We expect them to do. One would be, or what could be an indication of direction of things that will happen is the selection of the membership or the constitution of the Executive Council, selection of the core private, what you call private staff of the President, Chief of Staff, Secretary of Government, appointment of heads of government own enterprises, such as NNPC, NIMASA, and then the decision of the government on the subsidy removal, as well as the FX subsidy or deregulating the foreign exchange market, or having a one rate clear, one rate in the FX market. These are some of the things we should expect to hear in the coming weeks. And these are the factors that will drive our outlook or the performance of the economy in the coming in the second quarter. One is inflation. We expect inflation to remain a bit sticky in the second quarter of this year and begin to moderate in the third quarter of the year. The moderation will come from stability in the FX market. Hopefully, a new government will be able to rein in on insurgency and criminality in the north and some southern regions, and so that we could have an improvement in food production. We expect that the impact of the flooding we suffered last year will begin to moderate, and the base effect will kick in by the time we get to the second quarter of this year. So as for investments, we think the key thing is for a third world economy, an economy going through a political transition, investors should largely hold their assets in some form of liquid form, in easily convertible instruments, so that when opportunities become clearer and the outlook of the economy becomes more defined, investors can begin to take positions. Ordinarily, the predictions on bond prices have not met with expectations. We've seen that bond prices have continued to go down while yield is going up. Well, we were expected that would be the reverse. But we are hoping that in the next couple of weeks, there will be more clarity on the economic and political direction of the country, even as the electoral tribunal sit and take final decisions that will help define the incoming administration of in the country. Thank you, and remain blessed.
Thank you so much, sir, for this wonderful presentation. I think I speak for everyone when I say we have learned more than enough from this session. So now we're going to dive right into the question and answer section. And for those who might have questions to ask, please use the question and answer box below your screen, and we will try our best to answer your questions. Okay. So we have a question from Richard Akimoladu, and he says, kindly address the direct and indirect impact of subsidy removal, the possibility of this removal, and the role Dangote Refinery may play in this, and what sector may benefit from subsidy removal.
Okay, the subsidy removal will lead to an uptick in price of petroleum products, but will also lead to an availability of petroleum products. I have always advocated that if you want, by the time government wants to take out the subsidy must go with the FX subsidy, because if you take out the subsidy on petroleum product, you don't take out and you don't deregulate the foreign exchange market, you are going to have subsidy coming from the foreign exchange market, and this is why it will happen. If, for instance, you continue to sell FX at 435 naira to a dollar, and you ask people to bring in products, by the time they come to the market to bring in product, they are going to come to the central bank to get FX at 435 naira. So the landing cost of petroleum product will still not reflect the actual price it should have landed, because the exchange rate, if you use the parallel market, is about 745 naira too. And again, you're going to have, it could lead to also a lot of corruption, because those who are able to access FX from the central bank window will be landing the product at much lower cost than those who are unable to access FX. So you're going to have a scramble for people who have connection with the central bank, which will lead to a huge corruption. And the subsidy in effect will come back in form of FX. So I think the subsidy has to go both ways, I mean, FX and so the first place you're going to see an increase in the price of petroleum products. But because of the competition, and then it's about trading skills, that increment will not be sustained. Over time, it will begin to moderate. It will also, most importantly, incentivize businesses to set up refinery activities in the country. You know, Nigeria has what they call sweet crude. The API of Nigerian crude is quite high, which means our crude is light and it's easy to refine. So if we have a deregulated market, refinery will come out. Remember that government has given out a lot of licenses for local refineries, and that none of them have, apart from one or two that have come up, most of them couldn't come up. And even those who have come up are not refining PMS because of the higher cost of refining PMS. Then on Dangote Refinery will, to some extent, lead to a moderation in the landing cost of refined petroleum products, assuming it is subject to open market, free market engagement. Because remember that if the government restricts importation from Dangote Refinery, it becomes a monopoly in itself, and then the prices may not reflect the open market prices or free market prices. So, but the benefit will be that you no longer need to export crude to Netherlands or any of the foreign countries to refine and bring it back. So that lead time it takes to take crude to those locations will be saved. But Dangote Refinery will still have to pay for crude in dollar, even if it's imported from Nigeria. If it doesn't pay for crude in dollar and it pays in naira, Nigeria will be completely deprived of foreign reserve to meet other import obligations. So it has to be, if once he pays for crude in naira, in dollars, then the product it will refine and sell to the Nigerian market will still mirror to a large extent the international retail price of refined petroleum products, because it's going to buy the crude at the international crude market price. So it is not a silver bullet that most people think it is, but at best, you could say that the profitability associated with refined petroleum product will be trapped by a Nigerian entrepreneur.
Okay, thank you, sir. We have another question from Ibrahim Yusuf, and it says, most banks still have huge NPLs in their portfolio. Does this not portend huge risk to investors?
Well, the key thing is, yes, we should expect that to even increase further, the non-performing loans. Because like I said, once you have higher interest rates in any economy, you are going to see the incidence of bad loans will begin to increase. And it's very simple logic. When people borrow at 30% per annum and they have an asset conversion cycle of 6 months, then means that they have to, their margin, their gross margin will be in the region of 70% because they have to still pay their operating cost. So if they don't have a margin of more than 70%, then they won't be able to meet their retail payment obligations and principal repayment to the lender. That's the one of the problems associated with high interest rates. So, but I don't think, because the banks are carrying huge capital, they have very strong capital adequacy ratios. So I don't think an uptick, a marginal uptick in number of main loans would lead to any great concern on the bank's profitability. And I also say that the banks are also enjoying some level of windfall as a result of the central bank's continuous increase in lending rates, where the banks are now used as an excuse to charge higher lending rates or loan rates, while they're not increasing the borrowing rates that they pay, or what they call the deposit that the customers enjoy. So with that increase in net interest margin, increase in commissions and fees, and increase in bottom line, the banks are in a position to absorb any uptick in number of main loans.
Okay, sir, and we have another question that says, please, what's your outlook on FX? Kindly explain the dynamics of how a devaluation will bring about Naira appreciation in the parallel market.
Okay, my outlook is that if Naira, if the central bank or the central bank allows for harmonization of exchange rates, we should see an improvement or an appreciation of the currency in the parallel market. In fact, we're going to see a convergence that will be below the parallel market rate, but above the central bank rate. And this is basically what happens. Today, the same volume of liquidity, FX liquidity is available in the market. Part of it is channeled to the central bank window. That channel to the central bank window is available to those who have strong connections. So, and then you have the rest of all the citizens scrambling for whatever is available at the parallel market rate. So if all the available amount is brought to the single market, you're going to have a weighting of the rate. And this is basically what will happen. Because you now have an increase in overall availability. So the scramble for whatever little is available in the parallel market will moderate, because you're going to have a new clearing rate that will be lower than the parallel market rate, but higher than the official rate. Let me put it in graphical form. Assuming what I've currently availed in the market is $100 million on a monthly basis. Of that amount, $80 million goes to the official window, and $20 million come to the parallel market. But the demand in the market is that maybe 70% or 60% of the demand in the market comes to the parallel market, and only 40% goes to the official rates. So all of them will come to the market. Assuming currently what total demand is about 120 million a month. So what is available to the market is 100 million. So you are going to find a new equilibrium that we clear the market, not at the market rate where only 20 million is available, but 60 million was being demanded. So I guess you understand what I'm saying. So I think we're going to have a moderating effect on the exchange rate if we free up, we eliminate the multiple rates that we currently have.
Victor Omute is asking, by May 2023, population census exercise will commence. The same month, this present administration will be coming to an end. Do you feel fully well that census figures are used for economic planning and revenue allocation? There is a popular view that the exercise will be postponed for at least 7 months for the incoming administration to superintend over it. There is also the opinion that the technology to be employed by NPC is subject to audit by experts before the census exercise to avoid system compromise as witnessed during the general election. What is your opinion on this, sir?
Well, my take is that the challenge that we have with the current government conducting census, the current government has not proven to handle anything successfully without sense of responsibility. I mean, the last election is a living example. So they are concerned that the government may also foul up the census. Ordinarily, a census is important for the new government to come in so that they will have demographic data on the country and then hit the ground running with viable and reliable information. But the concerns are that we don't want to waste resources and then conduct a census that will also not be representative of the facts. So I think that's the major concern they have. As it relates to the government coming in May, when the election will be held in May, when the census will be held in May, the census is held for about 2 days or thereabout. So, and if technology is adopted, after 2 or 3 days, within a week, we should have the provisional data of the census. But for me, we should go beyond regular headcount, which should have been done every 10 years. The last one was 2006. Today we are this 16 years or almost 17 years after it was done. We should have a record of birth and death that we don't need to go back and count people every 10 years, every decade. With today, technology has made it possible for you to actually track all your citizens. We should have social security numbers, NIM, Nigerian identification number, that are applicable to every citizen. When people die, they should be recorded as having died and they be eliminated from the census population, and those who are born should be registered. I think we should go beyond this archaic approach of telling people to stay home every 10 days or every 20 years to be counted.
Okay, so Mr. Olubenga Oluwani is asking, in the oil and gas sector of the capital market, you mentioned that MRS is delisting. There is the news too that Oando is also delisted. Is this becoming a trend for key oil companies? And what exactly is driving the preference? Assume.
I actually wanted to mention that Oando is delisted, not MRS.
Okay, sir. So can we assume that the impact on the market is negative?
Of course, the impact on the market will be that you have fewer quoted companies in that sector. Of course, 11 PLC are already delisted. MRS is still listed. And then the question should be that why is the downstream sector of the oil and gas sector this challenge that operators are finding it difficult to sustain their listing, continue to meet their listing requirements. But clearly, the listing of a company as big as Oando will reduce the level of market capitalization, reduce the level of sectorial capitalization, and reduce the volume or availability of instruments tradable on the exchange. So those are the negative impacts that they could have.
How will continued immigration of the working population affect productivity in the economy?
Well, we've seen some industries, particularly the IT industry, banking industry, in fact, even capital market operators losing some of their most skilled employees to Canada and Europe. Today, we even in Cali had to even allow allow people to work from outside the country because we couldn't replace them immediately. So the key thing is that you are seeing the immigration of the most skilled citizens, workers, and this has led to weakening of delivery standards in some institutions that do not have a robust human capital capacity to replace some of those people. So it could also lead to slow down in willingness of foreign investors of foreign direct investment into the country, because one of the attractions of a country like ours, you have a large population, large workforce, and most importantly, you should have skilled workforce. If all the skilled workforce is migrating out of the country, foreign direct investors can as well go to where they are migrating to, like Canada, and set up there and attract them instead of coming to Nigeria. So it could be a setback to the attractiveness of Nigeria as an investment destination for foreign direct investors.
And Chris Okoro is asking, how will the equity market react to an interim government as has been reported in certain quarters? And what will be the reaction in the event that the Supreme Court reverts the outcome of the presidential election?
Okay, my personal opinion, I don't imagine an interim government. We shouldn't. I had mentioned in my presentation that this is the 7th election since the advent of the Fourth Republic. We shouldn't stall or reverse whatever gains we made in the democratic process. No matter how bad it is, I expect that the Supreme Court or the courts should address or redress whatever shortcomings or weaknesses we saw in the election. So the courts have a duty to make sure that they take the most appropriate decision on the election. Should there be an interim government, which I don't think there will be, then all bets are off. The investors will panic, local investors will panic, the economy will could go into a tailspin. And remember, the economy is already very fragile. So it's not something anybody should contemplate. An interim government should be completely out of it. But in the event that the Supreme Court, your question is that what would be the reaction in the event the Supreme Court reverse the outcome, or I believe you want to say reverse the outcome of the election? Well, it's all the realm of speculation. Let's wait and see what happens if that happens.
Okay, so we have another question that goes, please, what are the best practical alternative investments you recommend for Nigerian investors? And how can Nigerian investors get reliable and safe access to foreign dollar-denominated investments? Okay,
in my presentation, I mentioned that Nigerian banks are beginning to diversify their revenue sources away from not just in the local currency or Nigerian risk. That the likes of UBA, 60% of its earnings came from operations outside the country. So that also applies to individuals. If you have the wherewithal, you also may need to hold some investment in dollar-denominated assets. One, in case of further depreciation of local currency, you will not be so adversely affected. Assuming the government does not deregulate the FX market, or assuming the economy weakens further. So you have to look at that. Therefore, your Naira assets, I had suggested that you remain in the short end of the market. We have seen the TBs at 14.7%. That beginning to look attractive for investors. You can also keep your money in fixed deposits, which gives you an opportunity to reinvest the slightest opportunity of clarity on the economy. So stay in the long end of the market and watch the market, the macroeconomic environment.
We have another question. There's a growing worry about Nigeria's debt sustainability. What do you have advice to the incoming administration, sir?
Well, to manage the debt the current country currently have, the first thing is that the government cannot continue to be bullish in borrowing. The government must focus on balancing its budget, which will require that the government has to reconsider the approach of funding infrastructure. I've advocated that the government, because of the paucity of government revenue, the government cannot continue to fund infrastructure from budgetary allocations. And every kobo that is spent on infrastructure in the country in the past 3-4 years was borrowed. And we know the government is not the best in terms of extracting value from money. So if the government must borrow to fund infrastructure, you can as well leave it to the private sector. By concessioning some of the commercially viable infrastructure, the government is focused on social infrastructure, healthcare, education, security, and other factors. So I think the government has to move away from funding infrastructure, borrowing to fund infrastructure. That's one. The government, we have to consider taking those critical decisions. We said about 6.7 trillion naira will be spent on subsidy this year. I have said that I'm an advocate of taking out the subsidy, but the government must be circumspect on how it handles it. They must win back the heart of citizens before it takes such difficult decision. So subsidy has to go. That will reduce government borrowing need. Funding infrastructure from, concession infrastructure to the private sector operators will further reduce the government borrowing needs. And then the government has to take a second look at its overhead, which has consistently continued to increase. So, and then the third factor or the fourth factor, it is the government must grow its revenue. We talked about increase in crude production. So there also has to be consistent increase, improvement in tax effectiveness of tax system, so that the government tax revenue will also further increase. If you grow the revenue and cut down your cost, the government need to borrow will diminish, and then that is the only way to manage the debt profile. The key thing is that today, our GDP is in the region of 201 trillion naira. If it grows to, for instance, 400 trillion naira, or let's assume $500 billion, and then the debt service will moderate from current level of about 80% to, of course, the current level, if grows the revenue, and then the debt service will moderate. So the key thing is grow the GDP so that the government tax revenue will increase, or bake a bigger pie so the government can extract more value from that pie, and then that will help us moderate the debt burden.
Thank you so much, sir. I believe that's as much questions as we can take for this session. For all questions we could not answer, please, we would ensure to answer those questions offline. And for anyone who might have an inquiry for now or later on in the future, please send us an email at info@cowryassets.com. Thank you, sir.
Thank you, everyone, and thank you all for joining and listening.
Also, I'd like to note that the webinar materials will be distributed via email to everyone who has been a part of this session. On that note, I would like to call on Mr. Charles Sadi to give us a vote of thanks.
All right, thank you so much for the invitation, and I would like to sincerely thank everyone that has attended this webinar session, and also appreciate your attendance in this regard. We look forward to a Q2 review, and then we do believe that by that time, the economy would have factored in the transition and then the takeoff effect into the new government. So, but I must commend the deep insight from Mr. Johnson Chukwu, and then the detailed analysis that we have enjoyed today. So I can only promise you that you have something much more better than what we have gotten today. And even as I reassure you again that Cowry Asset will continuously bring to the public knowledge of the economy, and then happenings, and the effects as it affects investment and other areas of economic activities. So we once again want to say thank you for attending, and do have a blessed day.
Thank you once again, everyone. Thank you for your time, and we hope to do this once again. Have a good day.